Making investment mistakes is a rite of passage for all investors, regardless of experience level. However, some mistakes are more common than others and can be costly if not avoided. Being aware of these errors can help ensure your success in the market. Hello everyone, welcome to Wealthy Wisdom channel. In this video, we will talk about the top 8 common investment mistakes you should avoid. So if you're looking to invest your money, it's essential to be aware of these mistakes so that you don't lose out on potential profits. If you're new to this channel, like and subscribe to the track. Common investment mistakes number 1, investing in penny stocks. Many think investing in penny stocks is a surefire way to make money quickly. However, penny stocks are one of the riskiest investments you can make. Here are 3 reasons why you should avoid investing in penny stocks. First, they are highly volatile. Penny stocks are known for their high level of volatility, which means that they can go up or down in value rapidly. This can make it difficult to predict when to buy or sell, and you could lose a lot of money if you don't time your investment correctly. Second, they are often scams. Unfortunately, many penny stock companies are nothing more than scams. The promoters behind these companies often use deceptive tactics to lure investors, and the chances of actually making any money from these investments are slim to none. Finally, they are not well regulated. Unlike other types of investments, penny stocks are not subject to the same level of regulation from the government. This means there is more opportunity for fraud and manipulation by those who control these companies. Common investment mistakes number 2, not doing the research before investing. Investing is critical to building long-term wealth, but it's not without risks. One of the biggest mistakes that novice investors make is failing to do their homework before investing money. Understanding any investment's potential risks and rewards is essential before putting your hard-earned money on the line. Without proper research, it's easy to get caught up in the hype surrounding a particular stock or company and make a poor investment decision. By studying an investment thoroughly, you can help avoid costly mistakes and increase your chances of achieving success. Common investment mistakes number 3, putting eggs in one basket. While it can be tempting to put all of your money into a single investment, this strategy is risky and can often lead to financial losses. When you diversify your investments, you spread the risk out over several different assets, which can help to protect your portfolio from market volatility. While no investment is guaranteed, diversification is one of the best ways to reduce your risk and maximize your chances for success. So, before investing, be sure to take a diversified approach and build a portfolio that includes various assets. Common investment mistakes number 4, not rebalancing your portfolio regularly. Asset allocation is key to any investment portfolio. By holding a mix of stocks, bonds, and cash, investors can protect their portfolios from the ups and downs of the markets. However, the asset mix can become unbalanced over time as some asset classes outperform others. For example, stocks with a strong year may make up a larger share of the portfolio than initially intended. This can leave the portfolio vulnerable to make a market downturn. To stay on track, it's important to rebalance your portfolio regularly. This means selling some of the assets that have increased in value and buying more assets that have lost value. By doing so, investors can maintain their desired asset allocation and reduce their risk of losses in a down market. Don't forget to like and subscribe to the channel if you like this video. Common investment mistakes number 5, ignoring fees and commission. When it comes to investing, there are a lot of things to consider, from picking the right stocks to monitoring your portfolio. There is much to keep track of. However, fees and commissions are the most important things to focus on. All too often, investors ignore these costs, which can eat into profits and leave you with less money than you started with. There are many different ways to avoid this mistake. First, make sure to do your research and understand all the fees associated with your investment. Second, look for opportunities to trade without incurring commission costs. Finally, don't hesitate to negotiate with your broker or ask for fee waivers. Paying attention to fees and commissions can save you a lot of money in the long run. Common investment mistakes number 6, ignoring inflation. Investors often overlook the impact of inflation of their portfolios. While it's true that inflation can erode the value of your investments, it can also present growth opportunities. By understanding how inflation affects different asset classes, you can make adjustments to your portfolio that will help you protect and grow your wealth over time. One of the most extensive effects of inflation is on fixed income assets, such as bonds. As prices rise, the purchasing power of fixed incomes falls. This means that if you're holding a bond that pays a fixed interest rate, the real return on your investment will be lower than the stated interest rate. For example, if you have a bond that pays 5% interest and inflation is running at 3%, your real return on the bond is only 2%. Inflation can also impact stocks, although it's generally not as direct. When companies' costs go up to inflation, they may pass some of those costs on to consumers in the form of higher prices. This can lead to lower profits and share prices. In addition, higher interest rates can lead to more expensive borrowing costs for companies, which can also eat into profits. Common investment mistakes number 7, chasing after high-risk investments. Many beginner investors mistake chasing after high-risk investments for earning a significant return. While making a lot of money with high-risk investments is possible, they are also much more likely to lose value. High-risk investments are usually less stable and volatile than low-risk investments. As a result, they can drop in value very quickly, leaving investors with substantial losses. Beginner investors should instead focus on low-risk investments that offer steadier returns. These may not provide the same potential for growth as high-risk investments, but they are much less likely to lose value, making them a safer option for beginners. Common investment mistakes number 8, panicking and selling when the stock market takes a downturn. While it is understandable to be concerned about losing money, it is essential to remember that the stock market is notoriously volatile and often experiences sharp dips. If you sell when the market is down, you will lock in your losses and miss out on the opportunity to buy back your shares at a lower price. In addition, you may miss out on the rebound that often follows a market crash. Instead of selling, holding on to your shares and waiting for the market to recover is usually best. Of course, this is not always possible for everyone, but it is essential to remember before making rash decisions. While it is impossible to avoid every mistake, you can put yourself in a much better position to make sound investment decisions by being aware of the most common ones. By avoiding these mistakes, you may be able to save yourself time, money, and frustration down the road. Have you ever made any of these mistakes? Let us know in the comments below. Thank you for watching. I hope you have learned something from this video. If you like this video, do give us a like and subscribe to the channel. Thank you and goodbye.